Hey everyone, welcome back to Corporate Decoder, the place where we decode the sometimes weird world of corporate filings. Today we're diving into a report from Citius Pharmaceuticals, and let me tell you, it involves a special share, a powerful CEO, and a whole lot of voting power. It sounds like the beginning of a corporate drama, doesn't it? Citius Pharmaceuticals filed this report called an 8K to let investors know about some important changes happening within the company. The main event, they're trying to get more shares of their common stock approved, and they've created a special share of preferred stock to help make that happen. The date of the report is April 16, 2025, so this is pretty recent news. The main event is a deal they made with Leonard Mazur, who is the chairman and chief executive officer of Citius Pharmaceuticals. Basically, the company created a new type of stock called Series A PERS stock and sold one share of it to him for $100. This share of Series A preferred stock is super important because it was issued in connection with a special meeting where the company wants to increase the number of common stock shares available. They want to go from 16 million shares to a whopping 250 million. This increase in shares needs to be approved by the stockholders, and that's where the Series A preferred stock comes in. The document mentions a preliminary proxy statement, which basically means they are asking for permission from their shareholders. There are certain rules in an agreement, and the details about this Series A preferred stock are spelled out in something called a certificate of designation. The agreement says that Leonard Mazur has to attend any stockholder meetings where this share increase is being voted on. He also has to vote the Series A preferred stock in a specific way, and if the company asks, he has to give them the power to vote the share for him. If you want to read the entire agreement, it's available as an exhibit to this report. This section is related to the sale of the Series A preferred stock. Because of certain rules, the company didn't have to register the sale of this share with the Securities and Exchange Commission. This section refers to the changes to the rights of the security holders. Again, the specifics are in the certificate of designation. Let's get into that certificate of designation now. This document spells out all the details about the Series A preferred stock. Each share has a massive amount of voting power, 1 billion votes. However, it can only be used to vote on this one specific proposal to increase the number of shares. It can't be used to vote on anything else. Here's the interesting part. The Series A preferred stock will be voted on the share increase in the same way that the majority of common stockholders vote. So if most common stockholders vote yes on the increase, then this special share will also vote yes. The Series A preferred stock doesn't get a say in whether there is a quorum, meaning a minimum attendance to make the vote valid. It only considers common stock for that. The Series A preferred stock can't be converted into any other type of stock, and it doesn't have any rights to the company's assets if the company is sold, goes bankrupt, or dissolves. This special share will be bought back either when the board decides or automatically after the company announces the results of the vote on the share increase. Leonard Mazur will get his original $100 back. Now for another change. The company also changed its rules about how many stockholders need to be present at a meeting for the meeting to be valid. They changed their bylaws, which are the internal rules of the company, to lower the quorum requirement. Before, they needed a majority of the voting power present, but now they only need 1/3. The company said they made this change to make it easier to hold stockholder meetings. If they can't get enough people to show up, they have to delay the meeting, which costs money and disrupts their business. The exhibits that the company included are available to read, like the certificate of designation, the changes to the bylaws, and the agreement with Leonard Mazur. Now let's step back and look at the big picture here. Citius Pharmaceuticals is trying to increase the number of shares of its stock, and they've created this unusual arrangement with their CEO to help make that happen. It's not uncommon for companies to want to issue more stock, but the way they're doing it here is a bit unique. Giving one person a share with that much voting power, even if it's only for one specific vote, raises some eyebrows. The company is saying they're doing this to ensure they can get enough votes to pass the share increase. This can often be a sign that they need the extra shares for potential fundraising or other corporate activities. One risk to consider is if the stockholders don't approve the share increase. It's difficult to say, but it would make sense that it might make it harder for the company to raise money in the future. Ultimately, whether this is a good move for Citius Pharmaceuticals depends on how they use the extra shares if the increase is approved. If they use the shares to fund valuable projects or acquisitions, it could be a good thing for the company. If they simply dilute the existing shares without creating value, it could hurt stockholders. It will be interesting to see how this all plays out and whether the stockholders approve the share increase. Thanks for watching. If you found this helpful, please like, comment, and subscribe to Corporate Decoder for more insights into the world of corporate filings.